This is the brief on the Phillips curve. Think of this 1958 concept as the ultimate playbook central banks use to balance jobs and prices. It's basically a macroeconomic seesaw. When unemployment goes down, inflation inevitably goes up. First, let's dive into the short-run trade-off. Low unemployment gives workers serious bargaining power, raising wages and consumer prices. Think of a hot job market like a crowded auction. Bidding wars for workers naturally drive up the price of everything. Conversely, high unemployment weakens purchasing power, so businesses drop prices. Central banks still use this logic today, adjusting rates to cool down or stimulate the economy. Second, we have to look at the long-run limits. So can a government just print money to keep everyone employed forever? Well, no. That just breaks the seesaw and causes runaway inflation. In the 1970s, economists proved that pushing unemployment too low sparks a dangerous spiral, introducing NAIRU, the baseline unemployment needed for stable inflation. Plus, the 1970s stagflation, caused by oil shocks, proved you can definitely suffer high inflation and high unemployment simultaneously. Finally, look at the modern, flattened curve. Human psychology and global tech have fundamentally changed the seesaw. We know inflation expectations alone can drive up prices in a self-reinforcing loop. But before COVID, the curve actually flattened. We had super low unemployment and low inflation. Why? Globalization and automation broke the traditional rules. So, is the Phillips curve dead? No way. It just evolved. While it isn't a perfect mathematical formula, it remains the essential framework for understanding exactly how we balance economic growth with price stability.
If you walk into your boss's office tomorrow expecting a 10% raise just because, you think groceries are getting more expensive, well, you aren't just reacting to inflation, you are actually actively creating it. Welcome to this deep dive.
Yeah, it's a wild concept when you really think about it.
Right. Today, we are decoding the Phillips curve. But we are really zeroing in on how our own psychological expectations of the economy can literally rewrite the rules of inflation and unemployment, at least in the short term.
Exactly. And, I mean, we all kind of know the traditional Phillips curve doctrine from the late 50s. Unemployment drops, inflation spikes.
Right, like a playground seesaw.
Yeah, exactly like a seesaw. It was treated like this really reliable menu of choices for policymakers. And to understand why that trade-off actually appears in the data, we really have to look at the mechanics of full employment.
Okay, let's unpack this. Because when the labor pool shrinks, workers gain a lot of bargaining power, right?
They do. Businesses desperately need staff, so they have to offer higher wages. And then, well, they hike their prices to cover those new payroll costs.
Right, but wait. If we look back at the 1970s stagflation crisis, that whole seesaw analogy completely broke down.
Oh, completely.
We had incredibly high inflation and high unemployment at the exact same time. It feels like the standard mechanism just broke.
Yeah, that was a massive shock to the system. It actually forced a huge rethink by economists like Milton Friedman and Edmund Phelps, because they realized that this trade-off only really holds up in the short run.
Oh, so it's not a permanent rule.
Not at all. They introduced this concept called NAIU. That's the non-accelerating inflation rate of unemployment. It is essentially the natural baseline unemployment level where inflation just stays stable.
Okay, but what happens if a government tries to artificially force unemployment below that baseline using constant stimulus?
Well, you don't just get a stable, higher rate of inflation. You actually get runaway accelerating inflation.
Wait, I'm struggling with the mechanics there. Why does it accelerate? Why wouldn't it just hit a new higher plateau and stay there?
Because of the leapfrog effect. Workers get, say, a 10% raise, but then they quickly realize that raise was entirely eaten by 10% inflation.
So they're basically back to square one.
Exactly. So the following year, they demand 15% just to try and get ahead, and businesses then hike prices by 15% to cover those new wages.
Wow. So the cycle just feeds on itself.
It does. It constantly accelerates because workers and firms are perpetually trying to outpace each other.
Okay, so how do human expectations actually hijack this short-run balance? Because it reminds me of a crowd at a concert.
A concert? How so?
Like, if you expect the person in front of you to stand up, you stand up church to keep your view. And soon, everyone is standing, but literally nobody can see any better. We just preemptively act on what we expect will happen.
That is a perfect analogy. What's fascinating here is how modern macroeconomic thinking models that exact crowd behavior. It all comes down to adaptive expectations.
Right, which is our core focus today. How do adaptive expectations actually work in this context?
So in the short run, If people see prices going up, they adapt their worldview based on that recent experience. They begin to expect that inflation is going to keep rising at that exact same rate.
Meaning they don't even wait for the actual economic data.
Exactly. Firms don't wait for wages to go up. They just raise their prices in advance to cover anticipated future costs.
Oh, wow.
Yeah, and workers demand higher wages immediately.
So the expectation of inflation creates the actual inflation. It completely bypasses the need for a tight labor market to trigger the cycle.
Yes, it becomes entirely self-reinforcing.
But wait, how do we explain the decade right before the COVID surge? We had rock-bottom unemployment, but inflation barely budged. If adaptive expectations are so powerful, why didn't the labor market set off that chain reaction?
Well, that is because structural changes in the global economy essentially acted as a heavy lid on prices. They completely altered the calculus behind those expectations.
You mean like the intense globalization and automation we saw?
Yeah, and fierce e-commerce competition. Plus, there was a massive decline in labor union power during that time.
Oh, I see. So even if a worker expected higher inflation, they just didn't have the collective leverage to actually demand those adaptive wage hikes.
Exactly right. Which means the traditional Phillips curve link was essentially flattened.
Because even with extremely low unemployment, a domestic company couldn't just hike prices to cover wages.
Right, because consumers could instantly find a cheaper alternative online. Or the goods could just be sourced cheaper overseas. That global structure prevented the psychological cycle from taking off.
That makes so much sense. So bringing this all back to you, the listener, this entire framework of adaptive expectations is the real reason central banks like the Federal Reserve or the Bank of Israel might deliberately raise interest rates to cool down a booming job market.
Yeah, they aren't merely trying to slow down consumer spending. They're actively trying to manage your psychology.
They need to convince you that prices will stabilize, basically to prevent that concert crowd from standing up and destroying your purchasing power.
It really shows that the economy is just this highly delicate balance. You have mathematical baselines, global supply structures, and then unpredictable human behavior.
Which leaves us with a pretty massive question to ponder. If forces like globalization and e-commerce flatten the Phillips curve by keeping prices artificially low over the last few decades, what happens to our economic seesaw if the world begins reversing those trends and deglobalizing?
This is the brief on the Phillips curve. Stemming from a 1958 study, it's the foundational framework central banks use to navigate the constant tug-of-war between creating jobs and keeping prices stable. First, the basic trade-off. It's a simple inverse relationship. Low unemployment gives workers more bargaining power, so wages and prices rise, sparking inflation. Conversely, high unemployment during a recession weakens purchasing power, lowering inflation. Think of it like a macroeconomic seesaw. Policymakers originally thought they could just pick a side, trading a little higher inflation for lower unemployment or vice versa. But what happens when the seesaw just breaks, and both unemployment and prices skyrocket at the same time? That's our second takeaway, the long-run reality check. The 1970s stagflation and oil shocks proved this trade-off is actually only temporary. Economists Milton Friedman and Edmund Phelps introduced NAIRU, the specific baseline unemployment level needed to keep inflation stable. Drop below NAIRU, and inflation accelerates. Plus, human expectations really matter. If we expect inflation, we demand higher wages up front, making it a total self-fulfilling prophecy. Finally, the flattening of the curve. In pre-COVID decades, advanced economies saw super low unemployment without triggering high inflation. Why? Well, structural forces like globalization, tech automation, and weaker unions basically severed that traditional link between jobs and prices. So if we had low unemployment and low inflation, is this whole theory just completely dead? Not quite. While it's no longer treated as some flawless mathematical formula, the Phillips curve remains the absolute ultimate framing tool for central banks desperately trying to juggle economic growth with price stability.
If this Phillips curve breakdown clicked, hit like, subscribe, and the bell for the next macroeconomics deep dive. Thanks for watching.